January 2026. For years, the global economy danced to the rhythm of silicon and software. But in the early hours of Monday, the music stopped. In London and New York, the air in the pits grew heavy. This wasn't just a correction, it was the sound of a structural collapse. Headlines flashed across every device: tariff panic, Bitcoin swings, and a silent, terrifying surge in the price of gold. The narrative that had driven the last decade was breaking apart. At the center of the storm lay the crown jewel of the modern age: artificial intelligence. For 2 years, the AI bubble expanded on the promise of infinite productivity. Billions were poured into vast humming server cathedrals. But as 2026 dawned, the lights began to change. The gap between hype and realized revenue had become a canyon. Complex projections failed. The chips that were supposed to build the future were now piling up in warehouses unwanted and overvalued. Major tech giants, once thought invincible, announced unprecedented layoffs. The engine of the bull market had finally seized up. As the tech sector buckled, the geopolitical stage ignited. Trade routes that once flowed freely were suddenly sliced by new, aggressive tariffs. Across the Pacific, cargo ships ground to a halt. The global supply chain, already fragile, began to unravel under the weight of protectionism. Currency boards in Tokyo and Shanghai spun out of control. The dollar, the euro, and the yuan locked in a volatile downward spiral. Retail investors watched their life savings evaporate on smartphone screens, their faces washed in the sickly red glow of crashing portfolios. Traditional indicators were broken. Safe havens like gold and Bitcoin decoupled from the indices, moving in ways no algorithm could predict. The old rules no longer applied. We had entered a new economic reality, one where volatility was the only certainty. As the sun sets on the era of easy growth, the world waits for what comes next. The storm has passed, but the landscape is forever changed. The AI bubble, tariff panic, and the 2026 market trap. A documentary analysis of the year the world stopped trading on hope. In the end, only the most tangible assets remained, a hard lesson for a digital age. By the dawn of 2026, the world was no longer just watching the AI revolution. We were consumed by it, living in its digital shadow. For years, artificial intelligence was the ultimate siren song of the global markets, a promise of infinite growth and machine-led prosperity. Every investor, from institutional giants to the retail trader in their bedroom, saw AI as the untouchable, inevitable engine of the future. We were in the golden age. Stock charts for the Magnificent Seven and their successors didn't just climb, they verticalized, defying every traditional law of economics. The euphoria was intoxicating. It felt like a new era of alchemy, where capital was effortlessly converted into silicon-driven intelligence and limitless profit. But as 2026 progressed, the first whispers of doubt began to echo through the corridors of power on Wall Street and beyond. The narrative began to shift from what AI could do to what it was actually costing. The CapEx problem became the new obsession. Traders who once cheered every GPU shipment now stared at their screens with a growing sense of unease as the bills came due. The disconnect was becoming undeniable. Tech valuations were soaring to the moon, while actual revenue growth was stuck in Earth's atmosphere. Institutional heavyweights began to pull back, questioning if the massive investments in server farms would ever see a commensurate return in our lifetime. The weight of expectations is a heavy burden. For AI, the dream was no longer enough. The market demanded cold, hard numbers. Headlines that once hailed the AI miracle now turned predatory, sniffing out missed quarterly targets and bloated research budgets. Consider the visual metaphor of the era: a skyscraper built of glass and light, beautiful to look at, but showing structural cracks in the foundation. The tension was palpable during every earnings call. The visionary promises of CEOs were increasingly met with silence or sharp skepticism. As the cracks widened, the psychological landscape began to shift. The fear of missing out, FOMO, was being replaced by a much older emotion: fear. On Wall Street, the atmosphere turned grey. The London Stock Exchange and Tokyo's financial hubs mirrored the darkening mood under overcast skies. Capital began its exodus. The flood of money into high-growth tech started to dry up, diverted instead into safer defensive sectors. The market was sobering up. The party was over, and the lights were coming on. It was time to look at the new reality. AI hadn't failed. It had simply matured. It was no longer a miracle or a magic trick. It was finally just a business. As we look to the horizon, the hype has faded, but the transformation remains. We are entering the era of the practical, the sustainable, and the real. In the early months of 2026, the global financial landscape underwent a seismic shift that few were truly prepared to navigate. The breaking news alerts weren't just headlines. They were the first cracks in the foundation of decades of global trade cooperation. Market volatility spiked to levels unseen in years. On screens across the world, indices like the S&P 500 began a jagged descent. From Tokyo to London, the fear was palpable as the reality of a new protectionist era set in, disrupting every financial model. As the storm broke, the question was no longer if the economy would change, but how quickly the world would fracture. Beyond the trading floors, the tension moved to the world's arteries, the global supply chains that keep the modern world moving. Logistics networks, once optimized for speed, were now grinding to a halt under the weight of new tariffs and regulatory hurdles. Commodity prices reacted instantly. Copper, steel, and lithium, the building blocks of the future, became pawns in a high-stakes political game. The flow of goods didn't just slow down, it became a complex puzzle of evasion and skyrocketing costs for manufacturers everywhere. In factories across the globe, the rhythmic hum of automation began to fade as production lines were re-evaluated for a new reality. The cost of uncertainty is often higher than the cost of the tariff itself, leaving businesses paralyzed in a wait-and-see pattern. At the center of this chaos are the people, the traders and analysts who must price the risk of an unpredictable future. The psychological weight of 2026 is visible in the exhausted faces across trading floors in New York, London, and Hong Kong. Every news alert is a potential catastrophe. Every policy leak is a reason to sell. The human element of risk is peaking. In the quiet of high-end offices, the tapping of a pen on mahogany is the only sound as the world's wealth is recalculated. The complexity of 2026 isn't just about numbers. It's about the erosion of trust in the institutions that once guaranteed stability. Policy uncertainty has become the new benchmark. When the rules change daily, traditional economic formulas begin to break down. We see the shift in golden currency charts, jagged moves that signal a flight to safety and a rejection of the status quo. As the sun sets on the era of open markets, a new, more guarded reality is beginning to take shape across the globe. Adaptation is the only path forward. In a sea of red data, the first signs of a new equilibrium are starting to emerge. The market of 2026 is a test of resilience. For those who can look past the shock, the next phase of global finance awaits. The year 2026 began with a promise of unprecedented growth, driven by an AI revolution that seemed like it would never end. For retail traders like Mark, the allure was intoxicating. Every chart was a ladder to financial freedom, every ticker a new opportunity. The atmosphere in the digital forums was electric. Success felt inevitable, and the greed was masked as visionary intelligence. But the market is a fickle god. It gives with one hand and prepares to take with the other as soon as the hype peaks. By the second quarter, the narrative began to shift. The vertical lines slowed, and the first whispers of a bubble started to circulate. Then came the crash. It didn't start with a bang, but with a series of red candles that refused to stop falling. Panic is a physical sensation. It starts in the gut and spreads to the fingertips. For Mark, the screen became a source of terror. He watched his portfolio draw down by 20, 30, then 50%. The wealth he thought was his was evaporating in real time. The phone was a barrage of liquidated positions and margin calls. Every buzz was another blow to his financial stability. Desperate to recover, Mark looked for a lifeline. Bitcoin was rallying while stocks bled, a classic rotation born of pure FOMO. He didn't want to be left behind again. He moved what was left of his capital into the digital gold, chasing the vertical pump. But chasing a local top is a dangerous game. The market knew his desperation, and it was ready to punish the latecomers. The volatility of the crypto market was a different beast. Within hours, the gains were wiped, replaced by a deeper, more hollow defeat. Exhaustion set in. The thrill was gone, replaced by a heavy, leaden weight in his chest. He sought safety in the traditional. He traded the remaining fragments for gold, a defensive retreat that felt more like a surrender than a strategy. The office that once felt like a command center now felt like a prison. The silence of the night was deafening. In the end, it wasn't just the money that was lost. It was the time, the peace of mind, and the belief in the easy win. Mark stood up and walked away, leaving the glowing screens behind. The game was over, and the cost was finally realized. The markets of 2026 will be remembered for their brutality, a reminder that sentiment can change faster than any algorithm. The year is 2026. Global finance has reached a tipping point where digital code meets institutional power. Bitcoin ETFs, once a fringe experiment, now dictate the heartbeat of the modern market. Beneath the oceans, miles of fiber optic cables pulse with trillions of dollars in lightning-fast transactions. In sleepless urban centers like Tokyo and London, the gaze of the retail trader remains fixed on a single dashboard. Every second matters. Every fluctuation is felt globally. This is the new frontier of risk. But as institutional capital floods the gates, a paradox begins to emerge. We were promised digital gold, a stable store of value amidst the chaos of traditional currencies. Inside the boardrooms of Wall Street, the charts tell a different story of massive inflows and sudden retreats. The correlation is undeniable. When the global economy sneezes, the Bitcoin ETF catches a cold. Macro events, interest rates, geopolitical tensions, now drive the very asset that was meant to be independent. The digital gold is becoming a mirror, reflecting every tremor of global risk sentiment. When the narrative shifts from accumulation to exit, the anatomy of panic reveals itself. Thousands of browser windows flicker across the globe. The search for safety begins in a frenzy. On the trading floors, the lighting shifts to a deep, ominous red. The digital order books move at lightning speed. Fear isn't just a sentiment, it's a physical reaction. A trembling hand holds a phone as values plummet. This is the speculative tension of 2026, the collision of high-level strategy and primal human emotion. Financial hubs like Hong Kong and New York sit under stormy skies, literalizing the economic turbulence. While institutions move with calculated slowness, the digital world reacts in microseconds. In the end, we are left with a landscape defined by volatility and unresolved questions. The Bitcoin symbol remains steady, but surrounded by a blur of motion, a digital anchor in a shifting sea. The era of easy growth and unbridled speculation has finally met its silent end. The global markets of 2026 are shifting. The promises of the tech boom are flickering out. AI hype, once the engine of the economy, is hitting a wall of reality. The exuberant noise of financial influencers and retail manias has faded into static. The market is no longer a playground. It's a fortress. Institutional traders, the architects of capital, are retreating into the shadows. They are no longer chasing the next unicorn. Geopolitical uncertainty is the new baseline. Across the globe, the lines on the map are being redrawn by economic necessity. Industrial ports, once the symbols of globalized expansion, now stand in the long shadows of protectionism and strained supply lines. Government buildings remain stoic and impenetrable. Behind these doors, the policies of the new isolationism are being drafted. The VIX, the market's fear gauge, is no longer spiking. It is plateauing at heights unseen for a generation. We are witnessing the flight to safety, a massive migration of capital away from risk and toward the bedrock of stability. Trillions of dollars are moving. This isn't a panic. It's a calculated, defensive rotation into the assets that can weather the storm. The focus has shifted from high-growth tech to the unglamorous strength of blue-chip defensive stocks and government bonds. In the quiet rooms of power, the new guard of institutional investors is repositioning. Protection is now the only priority. And then there is the ultimate sanctuary. When faith in the digital and the paper system falters, we return to the physical. Gold has reclaimed its throne, not as a relic, but as the final insurance policy in an era of global currency uncertainty. The charts don't lie. The vertical ascent of gold prices mirrors the deepening anxiety of the global financial order. This is a new economic reality. The long road ahead will be defined not by how much we grow, but by how much we protect. Capital does not seek growth when the world seeks shelter. Prepare for the defensive era of 2026. By the spring of 2026, the world seemed poised for a permanent ascent, driven by the intoxicating promises of the AI revolution. The narrative of infinite growth had captured the public imagination, creating a digital mirage that few cared to question. In dark rooms across the globe, digital displays of growth charts glowed with an intensity that masked the underlying tension of the market. Retail traders sat transfixed, their faces illuminated by the flickering blue light of multiple monitors, chasing the dream of easy wealth. This was the AI summer, a season of peak euphoria where data seemed more real than the ground beneath our feet. But the atmosphere began to shift. The first whispers of volatility arrived not as a bang, but as a series of sudden, sharp shocks. Tariff announcements flashed across news tickers, signaling a retreat from the global cooperation that had sustained the boom. In the great ports of the world, massive cargo ships sat stalled at sea, silent monuments to a breaking supply chain. The digital safety net of cryptocurrency began to fray. As red tickers painted a portrait of a sudden and violent exodus, investors turned back toward the old world, seeking the cold, hard reality of precious metals to hedge against the rising tide of inflation. The transition from AI-driven optimism to global panic was swift, leaving those who hesitated caught in the crossfire of collapsing narratives. Behind every statistic, there was a human cost. In dimly lit home offices, the euphoria of the previous months evaporated into thin air. Retail traders who had bet their futures on the hype now found themselves trapped, watching their life savings dwindle in real time. Fear replaced conviction as the primary driver of the market. Every notification was a new alarm, a new reason to panic sell. The city streets, once vibrant with the energy of a booming economy, now reflected the quiet desperation of a retail trap. We witnessed the psychological toll of a market that moves faster than human emotion can process, leaving conviction in the dust. As we reach the end of 2026, we are forced to confront the fragility of the systems we built upon layers of hype. The collapse of these narratives serves as a sobering reminder that emotional decision-making is the ultimate risk in any financial era. In the high-stakes game of global markets, the greatest trap is not the algorithm, but our own belief in a miracle that was never there. Beware the conviction born of euphoria. In the silence of the aftermath, only the truth remains.